Today, let's dive into the fascinating and often overlooked part of investing: behavioral biases. These are psychological tendencies that cloud our judgment and lead even the smartest investors to make irrational decisions. Today, we're breaking down the 9 biggest behavioral biases investors face, what they are, why they matter, and how to recognize them. So, with that, let's begin. Number 1, the overconfidence bias. This is one of the most common and most dangerous investor biases. Overconfidence bias happens when investors believe they are smarter, more skilled, or better informed than they actually are. They might think that they can constantly beat the market, predict price movements, or time entries and exits with precision. But the reality is, even professional investors rarely beat the market consistently. Overconfidence leads to excessive trading, ignoring expert advice, and taking bigger risks than necessary. In short, it's a bias that feels good in the moment, but can cost dearly over time. Bias number 2, loss aversion. Loss aversion is rooted in human psychology. Research shows that the pain of losing money is about twice as powerful as the joy of gaining it. So, what does this mean for investors? It means that they are more likely to hold on to losing investments, hoping that they're going to bounce back, rather than cutting losses and moving on. Or potentially, they might avoid taking new opportunities because they're afraid of another potential loss. This can lead to stagnation, missed gains, and portfolios that underperform for years. Recognizing this bias means learning to accept losses as part of the game and making decisions based on strategy, not on emotions. Bias number 3, herd mentality. Humans are social creatures. We tend to follow the crowd, especially in uncertain situations. In investing, this shows up as herd mentality when investors buy or sell simply because others are doing it. Think of bubbles like the dot-com bubble or the crypto surges and crashes. When everyone is rushing in or fleeing out, it's tempting to join the crowd. But following the herd often means entering at the top or exiting at the very bottom. Successful investors learn to stay grounded and make decisions based on facts, not on frenzy. Bias number 4, confirmation bias. Confirmation bias is the tendency to search for and believe information that supports your existing beliefs. If you're bullish on a stock, you look for articles, videos, and opinion that say that the stock will continue to move up, and you'll ignore or downplay anything that suggests otherwise. This creates an echo chamber that reinforces your existing point of view, even if it's totally wrong. At AMP Consulting Group, we challenge our own assumptions. We seek out opposing opinions, and we are willing to change course when the data says so. Number 5, anchoring bias. Anchoring happens when we fixate on a specific reference point, often the first piece of information we receive. For example, let's say you bought a stock at $100. Even if the company's fundamentals change or the market shifts, you might mentally anchor to that $100 price point. You'll tell yourself you'll sell when it gets back up there, even if it's no longer realistic. Anchoring keeps us attached to outdated ideas and can prevent smart and timely decision making. Awareness is key. The market doesn't care what price you paid. and neither should your future self. Bias number 6, recency bias. We all influenced by what just happened. If the market has gone up for a few weeks, we tend to think it will continue to go up. If it crashes, we panic and believe it'll crash even more. This is recency bias, where recent events carry too much weight in our decision-making process. But the markets move in cycles. Short-term trends don't always predict the longer-term outcomes. Long-term investors must zoom out, look at history, and avoid making emotional moves based on recent headlines. Bias number 7, familiarity bias. Familiarity bias is when investors prefer what they know. They might only invest in domestic companies, big brand names, or stocks from industries they work in. Why? Because it feels safe. But this can lead to significant under-diversification and missed opportunities in other sectors or regions. A smart portfolio balances familiarity with strategic diversification. Bias number 8, mental accounting. Mental accounting is when we treat money differently depending on where it comes from and how we mentally categorize it. For example, we might take bigger risks with a bonus or inheritance than we with our regular paycheck. Or we might refuse to sell a losing stock in one account even though we'd sell it in another. The truth is, money is money. Regardless of where it comes from, it should be managed with the same discipline and logic. And finally, bias number 9, the endowment effect. The endowment effect is when we overvalue something simply because we own it. Let's say you own a stock and someone offers to buy it at a fair market value. You might turn them down because you feel it's worth more to you, but objectively, it's not. Ownership creates an emotional attachment. An emotional attachment clouds rational judgment. Investors should regularly review their portfolios with fresh objective lens and ask, would I buy this today? If not, why am I still holding on to it? So some final thoughts. Behavioral biases are part of being human, but recognizing them and learning to manage them is what separates successful investors from the rest. Stay disciplined, stay self-aware, and always invest with a clear, informed strategy. At AM Consulting Group, we are well aware of these behavioral biases. That's why we have formed an investment committee in order to stress test our ideas and to avoid groupthink. If you'd like to find out more about our process, please contact us at info@advisormanageportfolios.com. We look forward to speaking to you soon and educating you further. Till next time.